Welcome to today's Explainer. We are jumping right into the mechanics of fractional luxury asset investing. If you've been searching for new ways to diversify and actually find yield in, well, unexpected places, you are absolutely in the right spot. Today, we're going to validate exactly how this new frontier of wealth building works and break down the complex structures that finally allow everyday retail capital to tap into the world of high-end, institutional-grade trophy assets. So let's start by confronting a massive anxiety facing wealth builders right now. Honestly, is your traditional 60-40 portfolio actually surviving 2026 inflation? You know the old model, 60% equities, 40% bonds. Well, it is fighting a seriously uphill battle these days. It's a harsh economic environment out there, and it's literally forcing a major rethink of long-term financial planning across the board. Which brings us to the modern wealth dilemma. We're witnessing this massive pivot in consumer psychology right now. Investors are aggressively demanding real scarcity. They want physical, tangible utility, rather than banking on highly volatile, speculative digital tokens. And it totally makes sense, right? Today's wealth builders want something they can actually touch, something that inherently holds its value precisely because it exists in the real world and is exceedingly rare.
All right, let's get into the mechanics of fractional luxury. The crucial thing to understand here is that fractional ownership is no longer just a finance buzzword. Not anymore. It is a validated, structurally sound financial bridge. It's actively democratizing access to blue-chip, institutional-grade trophy assets that, honestly, until very recently were locked away exclusively for billionaires and massive institutional funds.
Okay, so how does it actually work in practice? Well, it comes down to a super transparent three-step process. Step 1, the platform secures SEC qualification, meaning they're playing strictly by the rules. Step 2, they take a multi-million-dollar asset, think of a pristine vintage Ferrari F40, and they securitize it into legally sound LLC shares. And then step 3, retail investors can purchase those exact fractional shares for just a few $100. You are literally buying a legal piece of a world-class asset. And look, this isn't the Wild West anymore. The 2026 regulatory landscape actively protects your capital by mandating really strict platform transparency and rigorous asset verification. These underlying physical assets, they are thoroughly vetted, authenticated, and legally secured way before a single share is ever sold to the public. Let's do a deep dive into the asset classes themselves: art, wine, and collectibles. When you stack up the historical 10-year compound annual growth rate of blue-chip masterpieces against the traditional S&P 500 index, the numbers are just wild. The data proves exactly why smart institutional money consistently parks wealth in fine art. We're talking Picassos, Basquiats. They do this to safely outpace traditional market gains. But hey, the opportunity goes well beyond fine art. Rare spirits and vintage timepieces, they actually serve as incredibly sturdy, recession-proof anchors in highly volatile markets. So when equities swing wildly because of inflation or geopolitical news, a vintage Rolex Daytona or, say, a rare cask of single malt Macallan tends to just hold its ground. It provides incredible stability for your overall portfolio. And we're also tracking this massive trend toward functional luxury. With this model, your investment doesn't just sit collecting dust in some dark vault. It yields actual financial returns while granting you exclusive community access. Just imagine earning a solid yield on a rare supercar while also securing an invite to a private track day, or holding shares in a high-end vineyard while attending exclusive tasting events. It's a real game changer. Of course, we also need to talk about managing risk and liquidity. Understanding the illiquidity premium is absolutely vital here. In the primary market, you're usually planning for a 5 to 7 year exit horizon before the physical asset is sold and returns are distributed, so you have to be patient. However, modern secondary markets now allow you to trade your shares of these luxury assets immediately. That gives you incredible flexibility, depending entirely on your personal liquidity timeline. Now, to protect your portfolio from cyclical downturns, diversification remains the golden rule. You prevent overexposure by spreading your capital across multiple asset vintages and entirely different luxury categories. Basically, you don't want to just buy into one specific year of Bordeaux wine or collect a single artist. You want to broaden that horizon to mitigate your risk effectively. So let's put it all together and build your high-yield roadmap. In an ideal portfolio allocation, right alongside your standard equities and bonds, you'd have a strategic slice dedicated to non-correlated fractional luxury.
The primary goal is just determining that ideal percentage for your specific financial situation, say a target of maybe 5 to 15%. When done right, this maximizes your overall returns, giving your portfolio a significant boost in yield without taking on unnecessary correlated market risk.
Once you've allocated those funds, you want to put them to work efficiently. Step 1 is the eventual execution of the asset sale. Step 2, automate your reinvestment cycle on these platforms. And step 3, compound those newly unlocked gains directly into new high-yield luxury offerings. Setting up this automated reinvestment cycle ensures your capital is just continuously working for you, aggressively compounding your wealth over time. Ultimately, thriving in this frontier means utilizing sophisticated, data-driven appraisal tools. By leveraging hard data, market histories, and expert valuations, you empower yourself to stop being just a passive market observer. You transition into a highly strategic collector who makes confident, informed decisions based on verifiable facts rather than just chasing market hype.
As we wrap up this explainer, I really want you to ask yourself a crucial question. Are you just holding wealth, or are you collecting history? As you rethink your financial roadmap in the face of 2026 inflation and market volatility, think about what you want your legacy to look like. The traditional wealth models are shifting rapidly, and the frontier of wealth has officially changed. Thanks for joining me today, and keep exploring.